When it comes to making decisions about your 401k, one of the biggest questions you may face is whether to contribute on a traditional pre-tax basis or Roth after-tax basis. And that's what I want to help you figure out today. So first, let's take a step back and talk about the why behind a 401k. If your company offers a 401k plan, it's one of the best personal financial tools to minimize taxes over your lifetime and to build wealth for your future. When you have a small portion of your paycheck withheld on an automated basis and diverted directly into your 401k plan, you're saving money for your future, and you can use that when you no longer want to or no longer can work. And you get a potentially huge lifetime tax savings for doing that. Now, when you set up this paycheck withholding to make a 401k contribution, there are two main choices. You have the traditional pre-tax and the Roth post-tax. So first, let's talk about traditional pre-tax. Any money you contribute to your 401k does not get included in your taxable income and does not get taxed now. Once it's in your 401k account, those funds can grow and earn income tax deferred, which just means that you don't pay taxes on those funds while they're protected from taxes by the 401k. However, in the future, at the time you remove a portion or all of those funds from your 401k, whatever amount you withdraw is taxed at that time. And if you do that before age 59 and a half, there's actually a 10% penalty on what you remove, but there are some helpful exceptions to that penalty. So to summarize the traditional pre-tax 401k category, there's no taxes now, no taxes along the way, but all of what you withdraw in the future is considered taxable income. If you're married and have a household income of more than $120,000 or are single and have an income of more than $60,000, then it may make sense to lean towards traditional pre-tax contributions. Next, I want to talk about the Roth post-tax contributions. So any money you contribute to your 401k in this category does get included in your taxable income today, and it gets taxed now. Once it's in your 401k though, those funds can grow and earn income tax deferred, again, which just means that you don't pay taxes on those funds while they're protected by the 401k. The good news is that in the future, if you're over age 59 and a half and have held the account for more than 5 years, when you remove those funds from the 401k, whatever amount you withdraw is not included in your income and is not taxed at that time. Keep in mind though that similar to the traditional pre-tax, if you're not age 59 and a half and make a withdrawal from your Roth 401k funds, a portion of the withdrawal may be subject to taxes and a 10% penalty. Again, there are some helpful exceptions to the penalty that apply. So to summarize the Roth 401k category, you pay taxes now, but you have no taxes along the way, and all of what you withdraw in the future is considered tax-free if you wait until after age 59 and a half. If you're married and have a household income of less than $120,000 or are single and have an income of less than $60,000, then it may make sense to lean towards Roth post-tax contributions. Now, there's a few other important details to note about these two contribution types. For example, the same IRS maximum contribution limits, including the over age 50 catch-up contribution, apply to both traditional and Roth contributions. And as long as you stay within those total maximum 401k contribution limits for the year, you can contribute in any combination of traditional and Roth. So for example, you could do 50% traditional and 50% Roth, or 25% traditional and 75% Roth. You pick the combination. Also, if your company offers a match, then either traditional or Roth counts as your employee contribution in order to qualify for the match. So now that you know the difference between traditional pre-tax and Roth post-tax 401k contributions, log into your 401k portal and find the link or tab that allows you to make changes to your contributions and move it to the direction that you want. I'd love to know what else about 401ks I can answer for you, so please leave your questions in the comments below.